If you're into crypto staking or lending here in the UK, you know the tax rules can feel like a total minefield. Well, hold on, because things are about to change in a really big way. We're going to walk you through a special briefing put together by the experts at Pro Tax Accountant that breaks down absolutely everything you need to know. Let's get right into it. All right, let's just cut straight to the chase with the one question that has probably kept a lot of you up at night. For years, the answer to this has been a really frustrating yes, and it's created a huge headache for anyone in the UK's DeFi space. But that's all about to change. You see, this headache actually has a name. It's called the dry tax charge. Just imagine getting a tax bill for a transaction where you didn't even cash out into pounds. Well, that's exactly what was happening. Just moving your tokens around could trigger a taxable event. It was a massive problem, but as you can see, that was until now. So what is this dry tax charge really? Well, it's the heart of the problem. You'd lend out your crypto and boom, HMRC would see that as a disposal. So if your crypto had gone up in value, you were suddenly hit with a capital gains tax bill. But you had no cash to actually pay it with because you hadn't sold a thing. It was a complete catch-22 for investors. Okay, but here's where the story gets a lot better. After a whole load of feedback from the crypto community, HMRC has actually come up with a much smarter solution. Starting from the 2025 to 2026 tax year, we've got a brand new set of rules just for these types of transactions. Let's break down exactly how it's going to work. This right here is the perfect before and after snapshot. On the left, you've got the old way, instant tax paying. On the right, you've got the new no gain, no loss regime. What this means is that your initial transfer into a pool is now tax neutral. The taxes simply kick down the road until you actually sell or get rid of the asset for good. The bottom line, that awful dry tax headache is finally gone. Now, this is absolutely where most people might get it wrong, so stay with me. This next point is vital. While the no gain, no loss rule is fantastic news for your initial capital, it does not apply to the rewards you earn. HMRC draws a very, very clear line in the sand between your principal investment and the yield it generates. And this quote sums it up perfectly. HMRC is making a crystal clear distinction. The crypto you put in, that's your capital, and it gets the lovely no gain, no loss treatment. But the rewards you earn from it, aha, that's a different story. That's treated as miscellaneous income, and you're taxed on it in the year you receive it. This is a critical detail. So here's a pro tip that comes directly from that point. Because you now have two different pots of assets being treated in two totally different ways for tax, your record keeping has to be absolutely flawless. You have to separate your capital from your rewards. You need to log the value of those rewards in pounds on the exact day you get them because that's what your income tax bill will be based on. This isn't optional, folks. It is essential for getting your tax return right. Now let's look at the next step, which is putting some actual numbers to this. Because when you see the tax rates side by side, you'll understand exactly why this distinction between capital and income is so incredibly important for your wallet. First up, capital gains. For the 2025 to 2026 tax year, you get a £3,000 tax-free allowance. This is great for any profit on your initial investment when you finally sell. But here's the big catch. This allowance does not apply to your staking rewards because remember, they are treated as income. And this chart, well, it says it all, doesn't it? As a higher rate taxpayer, your capital gains are taxed at 24%. But your staking rewards, which are classed as income, are taxed at a whopping 45%. That's almost double. You can see how misclassifying your rewards could be a really, really expensive mistake. Let's quickly walk through a real-world example. Say you deposit 10 ETH and 30,000 USDC into a liquidity pool. Under the new rules, no tax is due at this point. Fantastic. Later, you withdraw, but now you get back 8 ETH and 38,000 USDC. Now you have a taxable event. So you've got a loss on your ETH, but a gain on your USDC. You get to offset that loss against the gain, and in this case, you're left with a net taxable gain of £6,000. That's the figure you'd pay capital gains tax on. Okay, we've covered the new rules on staking, but there is another equally massive change happening in the background. If the no gain, no loss rule is the carrot, then this next part is definitely the stick. The days of crypto activity flying under the radar of the taxman are officially coming to an end. And it's all because of something called CARF, or the Crypto Asset Reporting Framework. It's a new global standard that the UK is adopting. To put it simply, it means that crypto exchanges will now be forced to automatically report all of your transaction data directly to HMRC. There's no more hiding. They are going to see everything. And listen, this isn't some far-off, distant future event. Just look at this timeline. The rules kick in on January 1st, 2026, and the very first data dumps from exchanges to HMRC will happen in 2027, governing everything you do in the 2026 calendar year. The crucial takeaway is this: every single transaction you make from 2026 onwards will be on HMRC's radar. And what exactly will they be reporting? Well, pretty much everything. Your full name, your address, date of birth, your national insurance number, all of it, linked directly to a summary of every transaction you make. HMRC will be able to match this data to your tax return, so being accurate is no longer just a good idea, it's not negotiable. So, where does all of this leave us? The landscape has fundamentally shifted. On one hand, the new rules have removed a huge barrier for people wanting to get into DeFi. But on the other hand, the arrival of CARF means the compliance is no longer optional. The stakes are, without a doubt, higher than ever before.
Now, before we finish, a quick but very important disclaimer. The information in this briefing is for general guidance only. Crypto tax is incredibly complex, and everyone's situation is unique, so please don't rely on this as a substitute for proper, professional advice.
So, what's your best next step? You need to talk to the experts. The team at Pro Tax Accountant can give you tailored advice to make sure you're not just compliant, but also as tax efficient as you can be. You can reach them on WhatsApp or by phone at 079-8568-9912, or just drop them an email at info@protaxaccountant.co.uk. And for more updates like this, make sure you subscribe to their YouTube channel. Thanks for watching.